right, everybody, welcome in. It is my favorite time of the month. Once a month, I have the opportunity. I was just telling my daughter, I'm like, how cool is this? I'm like, my job is to just sit down and interview an awesome guy for an hour. Super successful, knows so much about options, and that's like, it's like, it just feels awesome. I feel lucky that I get to do it. Tom, I was talking about you earlier today, and I'll tell you this introduction. This is kind of funny. I'm getting a little weird right now. Just so my daughters, I have a son, two daughters, but I drive my younger daughter to school. My wife takes the older ones. They started making me listen to this new radio station called Unwell on Sirius.
Okay.
And the host is Alex Cooper, who she had a podcast called Call Her Daddy.
Yeah, no, I know her. I know her.
Yeah. So she calls her followers the Daddy Gang, and she's the founding father. And I make a joke of it with my girls. I'm like, you're not in it. I am. It's for daddies. I'm like, no, that's not what it is. And I'm like, no. She's talking to me. Anyhow, I said, with the trading gang, Tom would be the founding father. I'm like, there's no one that knows more than him about anything in the last 20 years of trading. And that's who we're interviewing today. And that's how I related you to Alex Cooper.
I'm sure she did not care about me. I can promise you.
But we're like the options gang or whatever it is. So welcome in. Nice to be here with you. What's been going on? What have you been up to?
I've just been listening to Alex Cooper. Sorry. Yeah. No. I do like her though. She's funny. She's good.
Yeah, the music's good. I will admit I find myself now listening when my kids aren't in the car. It's kind of embarrassing. So we had a bond. It's funny. I was talking today and I was like, I'm like, it's weird. Usually when the markets are really strong, I can think of all the reasons why we should be going down. I go, market's been really strong lately and I can't think of the reasons why we should be going down. And literally within minutes of me saying that, the bond auction happened and the market tanked. I'm like, oh, there's a reason. So what happened? Why do we think it happened? And why did the market react the way it did?
That's a lot of questions. That's a heavy ask there, Mr. Mesh.
Coming in hot while we're fresh.
Yeah, coming in hot for sure. It's funny. I was just finishing up my show with Tony. Well, actually, right after the bond auction came out, I was doing a podcast with Dylan Radigan. We do a weekly podcast called Truth or Skepticism. And sometimes it's political, sometimes it's, markets. It's everything kind of related. And my question of the day was, because we try to take both sides, point, counterpoint, and my question of the day was, what can actually make this market go down? Like, it's obviously, I don't think this is a person thing. Like if you played 20 questions, I don't think that the answer would be a person that could make this market go down. So in other words, it's not the president, it's not the executive branch, it's not the Fed chairman or any of that kind of stuff. What could really make this market go down? And we talked about, at potentially because of what just happened today in the bonds and stuff like that, hey, could it be just that, the bond market implodes and the bond market gets ugly and nobody wants to touch our debt, our treasuries. And then, obviously on the heels of this auction, it's a very interesting discussion because nobody really knows for two things. First thing is, the last time I heard a discussion on a treasury auction, I think was about 30 years ago. Like, I haven't heard anybody use this as an excuse for the market going down or for selling off. I think I got to go back to the 90s. I don't know about you, but I haven't heard like anybody talk about a treasury auction. That's number one. And number two, when you start to think about, the bonds where they're trading right now, what's probably most interesting to me is this truly handcuffs the Fed, and it kind of handcuffs a lot of what this current administration wants to do, trade wise, because how much deeper do you want to dig your hole when if other countries decide, you know what, we're not going to touch your debt, we're not going to buy your bonds and we're going to liquidate some of your assets. And then what are you guys going to do? like you're gonna live in your own ecosystem, and you're gonna run the risk of trying to support your own bond market, which is really tough to do. And it ties the Fed's hands at this point because you can't lower interest rates anymore. I mean, you literally cannot lower interest rates. If anything, with the bonds at 110, if you had to make an objective decision, you'd have to raise rates right here. So the question really becomes, and I know you're not I know you don't trade a lot of bonds and that kind of stuff, but a lot of us grew up kind of trading bonds. And so it's kind of second nature for me. It's not an easy trade. But I'm long bonds here, and I came in long bonds today. So I didn't have a good day because I thought that, I thought the next move was going to be higher. This is a new low today. This takes out the old low from what happened in April. And this puts a lot of pressure on almost, every duration, more so the long side, but, even the shorter durations got a little ugly today. So to answer your question, why? I have no idea. Was it no central bank, no other countries were buying our bonds? I mean, it's not a retail product. So what happened? Was it kind of just like a unified stance against the US to kind of say, F you for the trade wars? I mean, it could have been. It could be any of the above. Was it sellers instead of buyers? Do they have to go this low in price just to find buyers? It's kind of weird.
What about the Moody's downgrade?
It could be partially the Moody's downgrade, but all of those things are interrelated, right? Aren't they?
They all are.
Yeah.
What does it mean the longer term? What's the relationship with bonds and stocks? Let's say it became more of a longer term FU to the U.S. We don't like what you did with the tariffs.
Yeah.
We're going to play your game with the tariffs, but we're not going to buy your debt.
Yeah.
And we're going to teach you a lesson, and let's all not buy your debt. And let's say they want to draw it out for 3 to 6 months. How would that play out in a bad situation?
So the bad situation is that the alternative, because people have to invest, right? So the alternative to stocks are bonds. Now, the reason that people buy stocks is because the risk-free yield on bonds is not nearly as attractive as the positive drift is and the growth rate of stocks.
My favorite word, positive drift.
Positive drift.
We might talk about that again later, just to have like another.
Yeah, sure. I mean, I love those discussions.
That changed my life, that word. But we'll go back.
What is the, like if you have an expectation of, let's just say, 10% in stocks or 15% in stocks with related principal risk and everything else associated. But if that's your expected return, great. But what happens, that works out great when the bond returns are 4 and 5%. But what if bond yields go to 7%? And what if stock returns are projected to be 7%? Then you start to think, or 8% or 5%, you don't even know. Then what you start to get is a situation, well, if I buy the bonds, I have no principal risk. If I buy the shorter term bonds, if I buy longer term bonds, I have principal risk, but I also have upside. If I buy the short term bonds, I have no principal risk. If I buy stocks, I have principal risk. So at some point, there's a crossover between stocks and bonds. And that's the challenge that's always been the challenge for the Fed. That's always been the challenge, in the big picture, because you asked about big picture. And the big picture is if risk-free rates go too high, then stocks become unattractive. That's the risk.
If risk-free rates go too high, then stop, because you could just put your money in and get yields.
Yeah, sure. Exactly.
So are people in that case selling? Are they selling?
They might be. I mean, that's the risk. In order to raise capital to buy bonds, you have to sell stocks. And one of the things that fueled the stock market was when when bond yields went to basically zero, there was no reason to buy bonds, so you had to buy stocks, and that fueled the whole stock market rally. If it goes the other way and bond yields go to, bonds are trading 110 right now. Remember, if they trade 100, that's a 7% yield. So, there's a lot of things here that I mean, let's put it this way. The way I described it is bonds are a little bit closer to the edge than they have been in a long time. You know, I gave an analogy today. For the last 15 years, America's been having this big party, okay? And we invite everybody to the party for free because we have everything already. Everybody comes to the party, they bring a dish, they have a good time. Everybody wins. Everybody has a good time at our parties. And now we started charging to come to our parties. And nobody likes to pay a cover charge to come to our parties. And so there's less people coming to the party now. And that's the easiest analogy. The simplest analogy I can give. And,
to go with that, the bigger concern would then be not that they don't come, but that someone else throws a different party and more people would rather go there.
Yeah, the likelihood of that is pretty slim. I mean, the challenge for U.S. investors is nobody's going to convert to Japanese yen. Nobody's going to convert to Chinese currency or German currency or, euros. I mean, especially not because the dollar has been so weak as of late. It doesn't make any sense. So for U.S. investors and institutional investors, you're pretty much trapped in you're a one-trick pony. For other people, it always made sense to buy U.S. Debt because the dollar was so strong. You made money both ways. You made money by converting to dollars, and you made money by buying our bonds. Now you're losing money both ways. The bond yield, the bond principal is going down, and the dollar is getting killed. So it's a double whammy.
Now it's interesting because I remember in like 1999, 2000, thinking, oh, if you have $1 million, you could put it into bonds, earn 10% a year, money market. Like you could earn 10% and make 100,000 a year. I just remember that was the number then. It seemed like it was 10%, right?
In 1999, it was lower.
It was 1998, maybe. I don't know. I remember.
I think it was like maybe early mid 90s. I don't think we've had, 10% yields for a long time. But
what were they in during the mortgage crisis of 2008, 2009?
I don't know where they got to. It wasn't that high.
No, but so my thinking is if bonds have always been low,
yeah.
and for years that was the whole Tina expression, there is no alternative.
Yeah.
Right?
Yeah.
So the biggest risk to the stock market would be rising bond rates. That is right. That conversation makes sense. But if it became more extreme, then I guess it would eventually always switch back.
Yeah, I don't like overly worry about this stuff, but I think it's an interesting conversation. It's like a fun talking point. But, the thing I think that's important to people that are on today's webinar is just understanding how easy and how tradable these products are. I know you don't trade a lot of, futures and futures options, but there's no difference except for size between trading, /ZB, /ZN, bonds and notes and all that kind of stuff. They're very, very, very popular for retail customers, really popular.
Would you say what percentage of like Tasty's people on the platform, what would you say it is options versus futures?
Our futures business is about 20. Our futures business is this is not notional. This is just number of trades. It's like just under 20% futures, but we're the only firm in the world that does more futures options than futures. So it's kind of, our business is very weird. It's a weird mix. But we have the highest percentage of customers who trade futures of any online brokerage firm. And that's just because we have kind of a more sophisticated customer, I guess, or more advanced, or we make it simple for customers to trade futures or futures options. They trade the same way. So if you're going to trade an option in IBM or an option in NVIDIA, and you trade an option in the 10-year note, it's exactly the same. There's no difference.
I do want to mention, as I see questions coming in, and Jose said everyone's going to the baby oil party.
Yeah, I don't think so.
Is that the P. Diddy one? So if Tom's whole team is here. If you have questions, you could ask them. I see people already are. We appreciate that.
Yeah, we have Andy from our trade desk is answering questions, and Britt's on with me. She works on my team, so they'll answer anything you want. Nothing's off limits. Or you can send me an email, Tom at Tasty Live, later if you want to.
Yeah, and it's a free flowing conversation. Tom answers anything. So even if you want to say like, how do I learn futures? I'll ask him, and we'll give you the best answer for where you could get started, stuff like that. And it's always good to do. So.
Well, the thing that's interesting, Adam, is like people. This has always drove me crazy. Like you'll turn on like Bloomberg or CNBC, even though I don't, but you can turn them on and you'll hear a discussion on like yield curve, yields. You'll hear a discussion on like central banks and Fed and bonds, bond auctions, and like 99.9% of self-directed investors have no idea what any of those stuff actually means. But the second you trade /ZB, the 30-year bond, I promise you, you will never answer. You will never be confused by that question again. Like you will know exactly what it means, and that's what I love about it.
So it's easy to learn.
Yeah, it's like seriously, it's like it's easier than craps.
Jim, do you play the do not pass in craps?
No, I don't, because I'm an American, and I do not want to be. I consider that to be anti-American, and I consider that to be. I want to shoot the person that plays the don't pass, because I feel like I can't root against mankind. I can't root against my fellow gamblers. I can't do it.
Just as a contrarian who likes to go sell into trends,
I know.
I could see you walking over to. I understand what you're saying, so I get it. But I could see you seeing a really hot table and being like itchy to just go the other way. But
I don't want to be taken out back in the casino and be killed. I don't want to do that.
Fair enough. Yeah. You probably don't like gambling because
No, the funny thing is, I don't like it as much as I used to, but I do somehow I find sitting at a table in Las Vegas to be a little bit relaxing and fun. Like it doesn't. I actually enjoy it, so it doesn't bother me at all.
Do you go small or big? And it's all relative, but like
I mean, like I used to gamble big. I gamble small now, I guess. Like medium to small. I don't care anymore.
Yeah,
like I gamble small. I've reached the point in my life where I just go for fun. Like if I'm with my friends, we have fun. If I'm with my wife, she's like she doesn't really like to gamble, so then it's more of like, well, let's just kill some time type thing.
Yeah. Jim in Atlanta said, can Tom share the strategy he uses to sell premium? Did he sell put premium today? Naked spreads?
In the bonds, is he asking, or where?
Knowing Jim, I would probably say in the options market, but I'll let him clarify real quick and we'll make sure. Yeah. But I can tell you, Jim, that he doesn't do spreads.
No, I do sell some spreads, but I did sell naked puts in the bonds this afternoon.
Any market, he said, any market.
Oh, I mean, it really depends on the price of the stock, Jim, and stuff. But today, when you get a volatility expansion like this, I would rather trade small and sell naked than do spreads. But I do both. I'm 75% naked, 25% spreads, if that helps you. No, let me rephrase that. 75% naked and 25% define risk, because I'll do some like short strangles. That's a spread, but that's naked on both sides. So 25% define risk, 75% naked.
And then the follow-up, and I have some other questions. Jim said, do you average into your positions?
No, I do not. And there's a reason for that, Jim. The reason for it is that A, I believe markets are random, and B, I hate to add to losing trades. So the answer to your question is, do I average into trades? The answer is almost never, but I would say 5 or 10% of the time I do end up like adding to a position, but it's a very small percentage. It's 5 or 10 out of 100 trades. And the reason, again, is I have found over time that I always tell Adam the same thing. When genius fails, it's always because you trade too big. Because as soon as you think you know something, you know this, Adam. As soon as you love your position, you're dead.
Right.
You have to hate. You have to absolutely hate your position in order to make money.
Very, very accurate. And you know what I respect about Jim? Jim's been with me for years. When we do stuff, we talk about everything in small size because I want everyone to feel comfortable with what we're discussing. And then if you want to go bigger, you can. And I know Jim is one of those people that goes bigger. And there's two different sizes of people that go bigger. Some go bigger and then complain to you about how much money they're down because they put on 30 times what you said and then can't handle it. And there's others that trade it the exact same way. Jim does it the exact same way. So he treats it like the same trade that everyone else is, even though it's bigger. So he's been able to stay in things and ride some waves and done well, which is great.
That's good.
And he said, good point about genius failing. Can he walk? And I'll do one more, and then I have a lot of other people asking. Can he walk me through an actual or hypothetical trade where he sold premium and it moved against him, and he had to triage the position? How does he triage a short option position that's moving against him?
So, Jim, I would say that, especially in this market, I would say that statistically, and it bears out this way, I would say that 3/4 of my positions probably at some point move against me. So it's not a small number. It's well over 50%. I'm guessing it's closer to 3/4. And I think it's the same statistically. It's the same for everybody. So I think you need to be aware. Everybody needs to be aware of that if you are doing something and you're taking risks, there's, in depending on the odds of the trade when you first put it on, you're probably about 75% of the time going to have something that at some point is going to be against you. So the question is, how much is it against you, and what actions do you take? I have a very simple approach to trades that have gone bad. And I've talked about this with Adam plenty of times in how long have we been doing this, Adam? A decade almost?
Yes.
Feels like it, a decade.
Yeah.
I have a very straightforward plan. The first thing you can do when a trade goes against you, and this is something I don't do that often, but it's absolutely acceptable, is reduce your size. Because one of the things that freaks people out is the size of trades. And so one of the things you can do is reduce your size. I know it means taking a loss, but just if you have 10 contracts, maybe you go to 5, 6, or 7. If you have 20, maybe you go to 10, 12, 14, something like that. If you reduce the size of your trade, it's the first thing you do. But what we mostly do is either roll down the untested side if it's calls. If you're short puts and the market's going down, we roll down the call side. And if you're short calls and the market's going up, you roll up the put side. That's the first thing. If all you're trying to do is reduce delta, if that doesn't do enough for you, then you can either recenter the position by what we call buying the guts, and then recentering by putting in new wings, equidistant away, or however you want to do it, skew it, or you can roll out to the next month, which also reduces your risk. So you roll the untested side, you recenter the trade, or you roll out to the next month, which again reduces your risk by about 25 or 30%. The fourth thing is, like I said before, you can reduce the size of your position. But those are the mechanics that we employ every single day. Like this afternoon, I probably rolled down calls in 30 or 40 different stocks this afternoon.
Say good stuff, Tom. Thank you. And thank you, Jim, for the other kind words. Jake said it was a great book, Genius Fails. And
you know what? If you haven't read it, it is a great book. I don't know if you've had a chance to read it yet, but I strongly recommend. It's the long-term capital management, blow up in 1998, I think. But it's all those, it's Myron Scholes and all those Nobel Prize winners.
I'm writing it down now.
It's a bunch of Nobel Prize winners that got together to manage a hedge fund, and they said there's no way that vol could get to a certain level. They were premium sellers, and they were right that it's mean reverting, but they ran out of money because they traded too big.
Hmm.
It's
I remember that. I do remember that.
and it's aptly called When Genius Fails, and it's one of it's probably one of the most important books if you're going to be a trader that you should read. I don't know what year it was written, but it's I think it took place in 1998, and I remember trading through that entire long-term capital management debacle, and we knew that somebody was blowing out. We just didn't know who it was.
My favorite trading book ever was Reminiscence of a Stock Operator, but
It's a great book.
I will read Genius Fails. Um,
Great book.
Mary said, your thoughts on basis trading with bond market. We had a large money in bonds with Chase and withdrew it 3 weeks ago after advice on what is going on, and it sounds quite scary.
Yeah, well, I mean, if you're trading, I don't know exactly what you mean when you say basis trade, Mary. If you're talking about a normal basis trade is like a swap. And what a swap is that you're buying one duration and selling a different duration. So for example, it's like a yield curve trade. An example of a basis trade in the bond market might be you might buy the 30-year and sell the 10-year, or you might buy the 10-year and sell the 2-year. If that's what you mean, I'm totally comfortable, absolutely 1000% comfortable with that trade. Do it however you want, but just make sure you line up the notional equivalents correctly. So like if you're doing 2s versus 10s, it's like 3 or 4 2s versus 110. If you're doing 10s versus 20s or 10s versus 30s, I'm sorry, like ZN versus ZB, it's 2 ZN to 1 ZB. So you have to just know that it's a little bit nuanced, that you have to know what the ratios are. But other than that, yeah, I'm all in for, for interest rate swaps and basis trade. That's what we call basis arbitrage. And sure, it's a directional crapshoot that is somewhat mean reverting.
Patrick, also for anyone interested in checking out the Tasty Trade platform, I've been on it since it started. It hasn't been down yet, and it's exceptional for everything. So if you could just post a link for anyone who wants to check it out that hasn't, please do. Okay. Kathy said, do you calculate measure moves when, i.e. NVIDIA May 6 almost cleared the 50-day EMA? So going to earnings as a catalyst, do you make a measure move and what strike to take? Like the May 23rd 140 were very inexpensive and exploded. How do you handle upcoming catalysts? Sorry.
So I do. It's Mary, right?
Yeah.
No,
that was Kathy.
Oh, Kathy. I do, yeah. Kathy, look at measured moves, but not maybe the same measurement that you look at. So I only look at, like if I was to let's just find a stock where I don't have any kind of position on or anything. Let's just say like IBM. I don't have an IBM position right now. If I was to go to IBM right now and you said to me, let's just say they had earnings, they don't. But I do look at measured moves. So if I was going to put a July position on, I would look at the expected move for July, which is $18.90 or just $18.90. Yeah. So it's a $19 expected move. So my targets in IBM for July, the stock is closed at 260 today. My target would be $20 higher and $20 lower. That is the expected. That is the real expected move. Forget about technical analysis. Forget about any analyst report. Forget about any fundamental analysis. Based on real time high frequency market makers, they have a 70% chance that the expected move for the next 56 days or 58 days is $20 up or $20 down. And you can pick any spot in there that you want. So if you go to, 50% of that, $10 up or $10 down, you have almost 100% probability of a touch. And that's how I look at measured moves. It's all based on statistics and real-time quantitative analysis. This is the numbers that we use, and Adam knows this, on the Tasty platform are all a derivative of Black-Scholes. So it's all part of the option pricing model. So it's the most accurate you can get for any kind of expected move. There's nothing subjective about it except that it's only right about 70% of the time.
Thank you. Deanna said, ordered the book. Tasty Trade is a great broker. Love the fills and the customer service.
Thank you.
I agree. Joe said, great stuff. Jose said, genius fail. Sounds like the optionsellers.com story.
It is.
And wait.
Oh,
Yeah.
he's talking about the natural gas guy, right? Is that company?
No, I think he was. Yeah. He was
That guy. I forgot the guy's name, but it was a couple of years ago. Do you remember the guy that raised money for a fund and he was selling calls in natural gas? I think that's who he's talking about.
I didn't realize. David said, where's that located on the site?
It's on the trade page, right on the right-hand column. We only have Tasty's really, really simple. So if you look where my cursor is right here, it's right here on every single stock, every single expiration, every single stock, and we show it throughout the entire platform. Whenever you open up anything on the platform, it'll also have the expected move right here in brown. It'll also have the 1 standard deviation move in a dotted line. And then in a further out dotted line, it has 2 standard deviation moves. So everything's built right in the platform. Just, it's designed to simplify all the thinking you have to do.
Okay, a lot of questions today, which is great.
Fire them away, man. Fire them away. This is what we're here for.
Yeah. So for anyone interested in reminiscence of stock operator like Jack, just email patrick@adamesh.com and we have a digital copy we could send you for free, because that is outside of any copyright infringement since it was written in the 1800s. So we just give it away. But the other book was Genius Fails, which I think I will order myself, and I'm sure you can get it on Amazon.
Yeah. I love when Genius fails. And I also love, if you've never read it, Where Are the Customer Yachts? It's a great book it's an old one too, like 1938.
That one I read.
That's a good one. Yeah.
And then this question is, can you leverage T-bills using the 5% margin?
Yeah.
For example, could you buy 100,000 of T-bills in a $50,000 account?
Sure.
Okay.
But why would you? Like, why would you want to borrow money at 8% to get 5% on your money? Like, it doesn't make any sense. You don't get to borrow the money for free. So if you want to buy, I don't know if you guys know this about, let's see. I don't know if you know this about Tasty, Adam. You and I have never talked about this on air, but I'm going to bring up something right now. It'll just take 1 second, because I don't know if you can do it on the live stream platform that you use, but we've added fixed income and a T-bill page to the platform. I just don't know if I can bring it up, but as a customer, you can just buy your own T-bills direct on Tasty. I just don't know if it's going to work in this. Oh, here it is. Okay. So we have this now right on the Tasty platform. You see this icon right here? It's just a fixed income icon. And you just click on it, and these are all treasuries. And as a customer, you can buy whatever you want. And so if you don't have to go to a bank or do anything, you just do it right on the platform. You can buy any treasury you want. These are just actual T-bills. So, I mean, it's all on the platform. It's, it's for people that just want to park some money in T-bills. But here's the thing. You never want to borrow money to buy something, because, I mean, if you want to borrow money to buy a stock, that's totally fine. But if you want to borrow money to buy a risk-free investment, that makes no sense. And here, another thing you can do, if you want a T-bill rate or whatever it is, you can use SGov. This is just another, this is just an ETF. This is just an ETF that's interest rate treasury ETF with 90-day paper, and so you can do SGov or BIL, and there's no transaction fees at all, so it's free to trade. The other one is BIL, and you can just you can trade these, and they're just pure interest rate 90-day T-bills, and that's it. A lot of people make money.
Jose said I buy T-bills on Tasty, the web platform. So, and he said another good book is Thinking in Bets.
Yeah, that is good.
Jay Swizzle said, can we do coffee futures?
No, because coffee futures don't trade on the CME. They trade on the ICE, and they will not provide us data unless we pay $1,000 per year per customer, and we refuse to pass the data fees through to our customers. We're the only firm that does not charge customers for data, and we don't want to start. And if you want coffee futures, we would have to pay for the data, and I don't want to do it for the few people that want to trade coffee. It's a minuscule number. I don't, it's not, I don't want to pass through the fees to the customer.
Okay, lots of great participation today. I'm trying to make sure I'm not skipping over anyone because they're coming in hot. Jim might be
And these are good questions.
Yeah, I like it. The ICE exchange is the dark side. Daryl said, if buying a call in the money, do you ever do a percentage in the money? If yes, is it fixed or variable?
Everything with options is variable. We call it dynamic. In the option world, we say it's dynamic. But the answer is, if you're going to buy something in the money, there's no reason to go much more than one strike in the money. You want to still be around as liquid as possible. So yeah, if we were going to do something in the money, we go one strike. That's our max.
I wanted to bring up United Healthcare.
You should. I've been trading it nonstop, so I'm happy to talk about it.
So I mean, let's go back a little bit because this is like,
okay.
It's always interesting when, like, I don't know, the real world collides with the stock market and like you get like a bigger story. Yeah. And I mean, it sucks. Like the CEO of United Healthcare was murdered. Let's go back to that. Okay.
Well, one of their CEOs,
one of their high ups, was targeted and murdered by this like really good looking young guy. And somehow, I mean, feels like this with other things too. Like somehow the response was like, instead of everyone being horrified, some people were like, United Healthcare sucks. And like this whole backlash about the insurance, which, by the way, I've never heard anyone say anything good about the way the healthcare insurance runs. I've never heard one person say it's great. Everyone hates it. We know this, okay? But now all of a sudden I hear, and it's kind of weird because I have United Healthcare. I'm on United Healthcare, and I hear them say that they're being investigated for criminal fraud, right? Mm-hmm. And the stock I'm looking at has gone from 606 on April 11th to 302. So it's been cut in half. It's down 50%. And it's now down, I don't know why, after hours, another 8 points. I mean, yeah, United Healthcare can't fail. I mean, how many people are on that? Like, I don't even know how this works. So, like, I don't know. What are you doing with it?
So, like everybody else, I'm a contrarian. I also love trading, stocks with high implied volatility rank.
So you're selling puts?
Well, it started off that way.
Okay.
I kind of did a little.
You sound like you're in the principal's office and you're explaining what happened. You're like, well, it's
okay. The easiest way for me to say this to you is genius failed. Okay. The implied volatility exploded. The stock was down, like you said. It was trading like 308 when I sold most of the puts that I sold, and I put spreads. I sold put spreads. I sold naked puts. I sold all this stuff. And the next day it opened down like $40 or $50, whatever. It traded down to 250. And so I ended up having to sell some calls against it. Now I'm in way too deep, and I'm short call spreads and calls and puts and I'm all over the place. And I got hundreds of options. And I'm like, I dug myself a pretty good hole. Got mostly out of it by yesterday, but then today hurt a little bit. Have a little residual positions. I got into this stock because the IV rank got to 150. I don't know if you were watching it. 100 is the max, they can really close at the end of the day. But intraday it got to 150. The levels of volatility in there were insane. And the rumors about the company, until the CEO and a couple people from the management team stepped up and bought stock, the stock was in a free fall. Now it's kind of normalized. Then today some news came out that, it was just bad. The news that came out today was bad. It was all criminals crap. I don't know how true it is, but I have been trading the stock. The markets are not bad. They look wide, but they trade about 3 to 6 cents off mid price. And, it's the highest vol on the board. That's what was interesting to me.
I mean, so so if you
How
were
do you trade it?
if you started selling puts when it was at 308, you're probably doing good with that now.
No, because when it dropped $50 in there, I had to sell some calls. I got caught a little bit. I got whipsawed.
Oh, it dropped down to 248. You're saying?
Yeah.
Okay.
The next day.
We
call that bad timing.
And the volume, the volume's free.
The volume's been good. The volume's been good in there. It traded 110 million shares the other day. It was traded 44 million today. It's been trading. It's been the most active kind of stock. It's totally been in play. I wouldn't go crazy in there, but it's a trading vehicle. I mean, it's definitely got a lot of juice. I'm a noise freak. So you know what that means. That means I'm attracted to movement and uncertainty. I consider that to be opportunistic, and I consider the more noise, the more opportunity. So I'm attracted to chaos.
When did the news come out about the criminal investigation?
I don't know. Some of my guys on the trade desk today were saying today, maybe. I'm not sure.
No, I heard about it before today for sure.
Oh, maybe it was. Oh no, the criminal investigation was a couple days ago, but then more news today, this morning, about some nursing homes and stuff like that.
So, I mean, it was at 606. So someone knew this was coming because it traded down 200 points before this came out.
Yeah, they had a really bad earnings too. There was a bunch of things.
They said it was a nursing home today.
Yeah,
it was last night about the nursing paying.
Yeah.
David said last week. I think Mark said, I think they found out it was related to Medicare billing, not the broader group or individual health plays. Mary said, so you must love MSTR when you said you're attracted to it.
Well, the difference is I have a whole different issue with MSTR. UNH, I kind of understand. MSTR, we've talked about this before. I struggle with their model.
This is the one where not me, but we took the Ponzi scheme quote and made it a headline.
Yeah, exactly.
Look what Moody's did to BAC today. Did you trade BAC?
I did not. What did Moody's do to BAC?
Daryl, what did they do?
It's down $1.50.
Moody's downgrades top banks as retail investors rally with record stock buying.
Okay, I did not see that, but I don't really, as a trader, Bank of America is not that's where traders go to die. If you want to die as a trader, you don't want to die in the Bank of America option in an option montage on Bank of America. That's a slow, painful death. I'm going to avoid that.
Eric said, by the way, I love the participation today, guys. It's so much fun for us when the questions keep coming in. It's awesome. And you guys, I like having everyone write in. It's agree, death by bank, BAC. BAC doesn't move. Eric said, I have Take-Two, 190, 195, 5. Do you have an opinion on Take-Two?
Is it TTWO? I forgot. Is that it?
I haven't looked at it in a long time.
Either have I, or what did I say? TT.
Yeah, it is. TTWO trading at 226.
Yeah. Where am I on here? Take-Two. TTWO.
Mark said BAC needs some XLEX.
TTWO. Did they have earnings last night or something? Or they had the was that the lawsuit with Apple or something? Was that what it was? Or was some kind of I can't remember if it was something to do with their one of their with their gaming app. Yeah, stock was down from the open bill. I don't have an opinion in there. I don't really trade it.
Yeah. Mary said he was a newbie. My husband almost died on BAC. Laugh out loud. He was a newbie trader too. Dow's 11. BAC CEO Moynihan says he will be happy when BAC gets 100 PS.
Sometimes Mary, new traders and stuff, they try to find stocks that don't move that much and that they don't take any risks. They can test out strategies and stuff, but it's so frustrating that you're like, oh, why did I ever do this?
BAC's ugly sister, American Airlines.
Yeah, exactly.
Do you remember? I remember. I don't know why I'm thinking of this now. Just stocks that blew people up. Do you remember like Manu MANU in like 1999?
I do, but I don't remember why I remember that. I don't
got it cut in half, and a lot of people bought it, and then the next day it got cut in half again and wiped out careers. Where does Tom think the market will go in the next week or two? Do you try to think like that or no?
I don't really, but I thought before this week started, I thought we had a good chance of being down early and up late. Because as we get closer to, the long 3-day weekend and things like that, I thought that there was a good chance the market would, bounce on Thursday and Friday of this week. I don't know if I feel that way anymore after the tape action today. It certainly doesn't look good, but I thought we'd be stronger towards the end of the week. Longer term, I'm not very bullish, but short term, I thought they might bounce towards the end of the week and then get a little bit more overbought. I kind of felt like they had to trade 6,000 and they didn't.
Kathy said Nike's up on after hours, raising prices of tennis shoes and other apparel. Can see people buying now, but stock price up. Gary and Mark both said Take-Two proposed stock offering.
Oh, that's what it was, a stock offering. Yeah, Nike's up almost $2, and Nike's been a real pig as of late. So, I mean, it's nice to see it bounce a little bit.
I had to make sure that this was not inappropriate to say, but it's okay. Mark said I want to see Dick's choke on Foot Locker because Dick's bought Foot Locker. That's fine to say.
I think that's appropriate, but yeah, I don't really. I mean, I don't know anybody that trades Foot Locker, so I can't help you there.
Yeah, I mean, definitely. I think it's better not to think about where the market goes.
Oh yeah, for sure.
Yeah, retail is dead to me. I want to ask you about just along the positive drift mentality and stuff like that, and I'll tell you why. This is just separate. It's not related to stocks as much as it would be business. Like you've been in business with different people. There's a horse racing term that I learned from my dad, which was bet on the jockey, not the horse. What do you think about that?
I pretty much live by that when it comes to investing, but not public investing. Like public investing is too hard because, I have a rule, never fade a superstar, but it's really hard to do in a public environment because you don't mostly know who the CEOs are and stuff like that. But when I'm investing I try to invest in small companies because people gave me a shot. So I like to try to invest in other people to give them a shot. And so every year we make, probably a dozen or so investments. And I 100% of the time invest in the person. There's 8 million ideas out there. I mean, everybody's got a good idea. There's tons of smart people. You can't invest solely on smarts and you can't invest solely on ideas because there's so many good ideas and so many smart people. So you've got to invest kind of on what you feel is the integrity of the person and, obviously their know-how, but I want somebody, it's going to sound bad, but I always felt like I want somebody who's going to die in their chair. to make this company work. Like, I don't care, I want somebody that's going to kill themselves to make the company work. That's who I invest in.
So I had two different scenarios recently. One was a guy who had a really cool AI concept, who was smart, and we were talking about collaborating on something, and we spent months, and we just didn't really vibe. But I
Sure.
like the idea. But I just said to him one day, like, we were having, like, our conversations were like not friendly. I don't know why. And I just said to him one day, like, you know what, I'm out. I'm like, I think this is a great idea, but I'm out. And he's like,
Okay,
what do you
that's
mean
fine.
you're out? And I'm like, I just don't think you and I see eye to eye, and why start a relationship why take it any further if that's the case now? And he was like, do you want to think about it? I'm like, no. I'm like, I'm at the point in my age where I like you. I think it's gonna be great. It's just me and you aren't good. The other one was and that was in my area. So I prefer to invest in what I know, which is stocks. The other one was, there was a woman I was on the board with years ago for, like, I forgot what it was for, like a nursery school or something, like an event. And she was just like killer, like so impressive. Like, I remembered it. And she started like a boys clothing line. And I know nothing about boys clothing, but I was like, she's a killer. And I saw her, I'm like, I would totally bet on you. And then I saw her again. She's like, do you want to? And I'm like, yeah. And we had a conversation, and literally we said yes. And like within a day, I wired money over, and she like couldn't believe how fast I sent it. But I was like, I'm in. And she's doing, it's so fun. And it was like, I knew nothing about boys clothing. I was like, I know she's great and she's going to be great. And I was like, I keep saying that expression, like, you're the jockey. I bet on the jockey. I go, I don't know the horse.
Yeah, I get it. I've been on a lot of jockeys though that fell off their horse.
Mary said only business owners can really understand that statement. Die to make it happen. So yeah, just to reiterate, positive drift though, when it comes to trading, as I understand it, and I use it in a lot of different areas, but for trading, it means make a lot of small trades, right? To stay in the rhythm of the market.
Well, positive drift is one of the aspects of positive drift is that you have to play kind of the law of large numbers, because you can't be all in on a single investment or anything like that. So you are playing kind of, a law of large numbers game, and that, that over time your skill set and the amount of diversification you have, is going to lead to a positive return that exceeds risk-free rates. I mean, I'm a positive drift person on every level. Like, I think everybody, every company, every person needs to get better over time. Whatever you do, if you're passionate about something, you commit yourself to something, you need to get better. Like, that's just the way things work. If you're not getting better at something, I mean, unless it's like golf, there's no such thing as positive drift in golf. But if you're talking about, like, if you're working at something, you have to be better at your craft.
Yeah. Britt said, FYI, the Tasty Crew is heading to 17 cities this year. For more info to see Tom and the crew, please go here. There's a link. Also, if you want to open up a Tasty account, please go here. There's a link. Jack said, see you in Atlanta next week. Can't wait.
Yeah, it's my first show. It's my first road show this year. I took the first 3 or 4 months of the year off from being on the road, and now I go on the road the whole rest of the year. And Atlanta's our first stop next Friday. So if you're in Atlanta, you want to go, please come on by. But then I go to London and Milan. So if you have anybody listening today from London, from the UK or Milan, we'd love to see you. We'll be there in June.
With the idea of positive drift, when you're making a lot of trades, I found something that I think to be true, but I want your opinion on it, because maybe you'll tell me, nah, it's in your head. I feel as though when there's stocks that I've been trading, I can notice things faster in them in irregular movement than if I hadn't been, and it gives me a leg up, because I'll see a movement and I'll be like, huh, that's strong or that's weak. And then I'll start to participate, and I think I'm ahead of the game simply because I was already trading it. Do you think I have an advantage on entry because I am in the stock already. Does that go with positive drift?
I don't think that you have a I don't think that you have a true theoretical advantage. I think you have a huge um, emotional and conditional advantage, meaning that there's no question that if you're looking at something for the first time, it is very difficult to be comfortable with that underlying. If you're looking at something for the, you know, for like the 150th time, when you look at a stock, you're looking at it like 150 or 200 times. I mean, you never take your eyes off it. At that point, you feel so much more comfortable that you're much more likely to make better decisions. So I agree with you.
I like that. It gives you a mental edge. It's a confidence edge. Yeah.
Yeah, it's a mental edge.
That makes a lot of sense. As B said, does Tom have a max time limit he tends to keep on his swing trades?
I don't, but most of the time it's at least I'm comfortable for a couple of weeks.
A couple of weeks.
Yeah, I'm very comfortable for a couple of weeks now. But listen, I move stuff around a lot. Like I adjust. I'm a very aggressive adjuster. So don't think I'm not static for a couple of weeks, but I will keep things on. I'll keep things on for months if I have to, or weeks or months. Yeah, absolutely.
Just as an this will be a good finishing question. As B said, does he have a delta? He tries to target 30 delta, right? Or 20, 25 now?
Yeah, it depends. 2020. I'm 16 to 30, but I live in around 20-ish.
It keeps going lower.
Yeah, well, volatility keeps going higher.
Mary said, do you have trade on earnings? They've been pretty screwed up the last couple of months.
This is the best earnings cycle of the last 4 years. This particular quarterly cycle, there's only one earnings play that moved outside the range, which was Microsoft. And every single earnings play other than that was tradable, winnable, and came out nice. So this was the best earnings cycle. We've had some really bad earnings cycles. This was the best earnings cycle in I would say probably 4 or 5 years. But each one there's so many variables. It's so random. Next one maybe it's going to be horrible, but this one everything was inside the expected move.
Okay. Do you trade HIMS at all?
I never have.
Me either. Okay. So this will be a good one to like a two-parter where we'll leave people hanging. We'll ask one part now, and then we can continue next time with the other part.
All right, fire away.
In the spirit of reminiscence of a stock operator, if mentally you were just burnt, you were not happy. I know you would never do it, but you're like, I'm on tilt, whatever. If you come in and you need to make a good trade, a get right trade, what strategy are you using for your I need to feel good about this, and this is the trade I'm going to make? What's your strategy?
I'm not so sure that that's a very easy question because, I sell a lot of premium, but if I had to just pick one thing, one thing, don't touch it, can't do anything, I would sell a put. It's part of my positive drift philosophy. So the old Yiddish saying is puts or schmutz. So right. We'll go with that.
I did have one more question, and I'll continue on that part lesson because I think we could start next time by getting into the best way to sell a put.
Sure.
And spend a little time on that and get a little more technical.
Yeah,
next month. I just want to ask about. I've been hearing people talk a lot. I don't know why about Robinhood lately. Just like as a hot stock, I guess maybe.
Okay.
And being like in that space and knowing it. Do you trade other places like that or no?
Sure. Yeah, not a lot. I trade a little Robinhood every once in a while, not too often, but sure.
I mean, it's not as for real traders, it's not as ideal of a platform, obviously, but
no.
Yeah.
But I, I'm familiar with them, and one of my buddies runs Robinhood, and I know the CEO. The thing you got to be careful with if you're bullish on Robinhood or whatever you do with them, is you just have to remember they're highly dependent on crypto.
Is that why it's going up? Because people have been
Yeah.
buying the stock.
Yeah, it trades very highly correlated to like Coinbase and MSTR. They have a big part of their revenue is crypto related. So when crypto goes higher, Robinhood goes higher. That's the reason.
Okay, that makes sense. Okay, so first of all, amazing questions today. So many people, so many different people asking the questions. Like, I love it. This is really good. Uh, Jim, save that for next time because we're over time, and I want to ask that, and we'll ask it next time if you can. But I think next time we start with like setting up the ideal way to sell a put and go from there.
Let's do it.
And okay, thanks, Jim. Well, I got to ask Jim's question really quick because I don't want to leave him hanging. Real quick. In certain instances, my account size can't support share purchases of expensive stock, so I buy calls instead, and the trade duration is 1 to 3 days. I've been buying calls with delta over 0.89, so I get close to a 1-to-1 move with the underlying. Is there better criteria to call selection for this type of trade?
I mean, I generally don't like to buy 80 or 90 delta calls because the markets tend to be a little less efficient in there. But I understand that he can't afford the capital for the stock. So there's no more efficient way to do it, except, I mean, if you want to buy a call and sell a put at the same, it's virtually the same thing. So for example, let's use XYZ, Jim, and let's say you wanted to, instead of buying the stock, you wanted to buy the synthetic equivalent of the stock. You can buy the at the money call and sell the at the money put, and that's the same thing as 100 shares of stock. Exactly the same. Or if you want 80 shares of stock, you just buy the 40 delta call and sell the 40 delta put. That's 80 shares of stock. It's exactly the same. It is theoretically perfect, and you save. You don't have to put up nearly as much money, but it's still cheaper to buy the deep in the money call because that's even less. That's less money. But I'd probably buy the 60 or 70 delta. But other than that, no, you're doing it fine. There's nothing else you can do. That's the best way to replace it if you don't want to sell another call against it. A lot of people that want to buy in the money call, they'll sell a further out of the money call, do what we call a poor man's covered call. But the problem for you is that you're scalping it in 2 or 3 days. So you don't want to deal with that.
This was a great session. Go see Tom live. You have the dates. Tasty Trade's the best platform. We sent out the link. We could send it out again. Best customer support team there is. I talk about it all the time. Tom, this was great. Next time we'll start off with selling puts. I'm just writing that down.
All right, let's do it.
Selling puts. But I appreciate you so much. I really do. This is like really where I love what I do. I feel very lucky I get to speak to you. Totally appreciative and really look forward to these. So thank you.
Thanks, Adam. Thanks, everybody. See you next time, Adam.
Bye.